and it's probably a good time to talk about where I'm at because it has changed so much from last time we talked.
Yeah.
You know, my I raised my gold target 5,500, I think, in January, my January letter. And that came out obviously before the big run up in January. I raised my silver to 125. Now, silver went to 122 before it went directly south and got cut in half. Gold went to 55, I think, 5,500, and rolled over and went to 4,100. Um, During that decline, and I basically called that decline. Not didn't expect 50% out of silver, but I was on a podcast that week when silver had spiked, and I said, "This is it's gone parabolic in the short run. You could see a 30, 40%, 30, 35% correction." Well, we got 50 during that correction because it came down so hard. I revised my targets up, which is, as a contrarian, sentiment means a lot to me, and everybody got so bearish with that rollover. I raised my silver target to my current level, which is 180. So I'm looking for 180 on silver, and on my gold target to 6,800. So big revisions from when we talked. I think you
Yeah.
said my silver target was still 75, and my gold target was probably 4,000. Yeah.
Yeah.
So
Exactly.
so I think there is another big leg up, and will be parabolic. Another
Yeah.
steep leg up. We could be there this summer. Doesn't have to happen this. All of it happened this summer. You could spill into the fall, but I do expect another big run. Obviously this week I'm not thinking too many people are singing my praises because the miners are getting hit, the gold and silver are getting hit. There's all the gloom and doom about Iran and oil prices, and there's a lot of talk that silver's going back into the 50s, into low 50s, and gold's going down below 4,000. I don't buy either one of those. I think we are in a bottoming uh, place this week. It's the end of the month.
Mm.
If you look, there were lower levels in March. We rallied, and what's got everybody so bearish is we rolled back over. But I think if you look at it, it's likely the end of the month, kind of squaring of positions, and people going with the momentum. My guess is May and June will be very big reversal months.
Yeah, I'm trying to think if there's an economic term or a textbook term for when the bottom half of the country is in recession and the rest is doing just fine. I know there's the term K-shaped economy, but I don't think it really means what I wanted to express, right? Because I'm looking at Frontier, Spirit, so the low-tier airlines going belly up or asking for government handouts right now, which are exactly what you've described, the reasons or signs for what is happening in the economy, right? It's that K-shaped economy. Delta and all the others are doing fine, while Spirit and Frontier
Right.
are tanking, right?
Yeah, and you
Um,
see that in luxury goods are doing okay, but things that are kind of necessities are slowing down, or the lower end of the income scale. Retail markets are sluggish, but that's, I think, although it's probably more extreme this time. I think that's what you see typically going into a recession, is those that can afford it can keep pushing longer. But ultimately, these are early signs of a recession, I think, is what we're seeing. And
no,
ultimately, it will tip the entire economy over, but not yet.
no. Let's look at the labor market real quick, just as a maybe one indicator to look at. It's always lagging, but I'm curious, what do you make of the labor market? If I look at just the pure number, 4.3%, but I keep seeing news about layoffs at Meta and all the other places that are substituting now their workers for AI. So what do you make of the labor market? Is that where it might break?
Yeah, I think it's probably not just AI. I think AI is probably not going to be the tipping point. I think it's overall AI. Yeah, AI influenced technology workers and things like that, where AI is taking over. Yeah, some of that will be part of it, but I also think it is economic, and you will ultimately see it tip over. I would not be surprised to see, and I'm still calling for a global bust, that next year we move towards double-digit unemployment. So it won't happen fast. You're not gonna go from 4 to 10 or anything like that. But I think if the global economy really tips over into a credit crisis, this thing could get pretty ugly.
Absolutely, and I think we're already seeing a bit of stress in the private credit market here, David. What do you make of that part? Is it just a blip, or is it just a bump in the road? Is everything fine, or should we be concerned?
Yeah, I think it's what it is early signs that we are moving towards recession and ultimately what I call a global bust or a credit crisis. Um, you get the weaker areas, just like the consumer, the weaker areas show up first, and obviously, private credit is an area that got a lot of money in this cycle, and it's starting to show signs because some of that money chased some things that probably were a little more, you know, not should not have maybe been done. Um, and people in the private credit business would tell you this is normal. We price in for risk, and when that risk happens, we adjust. Um, so the market, who is newer to this, overreacts and says, "Oh my God, private credit, the bust is now." Whereas those in the business tell you, "No, there are write-offs. We're adjusting things, and at the margin, yes, it's deteriorating, but we're nowhere near, I don't think, the tipping point yet. That could come, in the months ahead, but I don't think it's a sign that we're about to roll over."
Let's go through the signs. Let's go through the signals and maybe cut through the noise as well. Let's look at the bond market. You've been calling for much lower yields. So far, we're at 4.2, 4.3% on the 10-year. That's the one I look at daily. So not much has changed. Doesn't seem like a run into safe or towards safety. What do you make of the bond market right now? What is it telling you?
Yeah, we've been basically in a range between, say, 4.25 and 4.50 for the last couple of months since the war began. I think that's amazing resilience, given what oil has done, given what that the inflation numbers are ticking up. Given talk that the Fed is nowhere near another cut, all of those things, and yet the bond market, it's the 10-year backed up, I think, to 4.39 this morning at last I looked. So it's up a little bit higher in that range. But it really, in my opinion, has been remarkably resilient in these 2 months since the war began, and that's a good sign. I continue to call for this is, that the bond market is in a bottoming formation that it's been in for the last 2.5 or almost 3 years, and that's a major bottom, a major top in rates, and that once we come out of that formation, once we come out of that bottom in bonds, you're in for a very big run in the bond market, a very long decline in rates, driven later by a global bust, a slowing economy, then ultimately recession, ultimately global bust. And I continue to say, although this is a crazy forecast, not unlike some of my others, and when they start out, very contrarian forecast, but I continue to say we could see a 0% 10-year at the bottom of the bust. Now that's 12 to 18 months out, probably, and maybe closer to 18. But if we're at 440 now, to go down to anything close to zero would be a remarkable run.
Has the structure of the bond market changed, or maybe the appetite for bonds in general, looking at the debt situation, for example, in the U.S., and then also the U.S. Treasury issuing more short-term bonds, meaning bills, as well? Does that affect your call at all, like the structure of the market in general?
Not this cycle. I do think it's a huge problem longer term, and I do think that on the other side of the bust, because of the response that will be necessary for the bust, which means massive money printing, we're going to have a situation where you're going to have huge debt, as we have now, 330 trillion in global debt. We know what our government debt is here in this country. You're going to have a situation where, out towards the end of this decade, you could have high double-digit interest rates and still have that massive debt, and actually higher debt because of what the response to the bust will be. So you could, what's 330, I'd like to quote the big number for global debt, the 330 trillion could grow to 450 trillion by, early 2030s. And so it's, even far bigger, and yet have interest rates in the high double-digit category. There's no way you can square that equation. Something's got to give, And what I think will give will be, this is the bust will be the kind of the warning signal. As bad as it will be, it'll be kind of the shot across the bow that this thing's coming to an end. And then I think the mid 30s, you're looking at, basically down for the count. The Ponzi scheme's over. The Ponzi scheme that's been in place for 80, 90 years comes to an end because you can't print money because there's high inflation and you don't have the wherewithal to service your debt. So even sovereign debt goes down the, tumbles over the mountain.
Let's talk about that debt part and the inflation part, but also the Fed, which I think is the main topic. I've shared the screen here just to show that we're recording this exactly 3 hours, 37 minutes, and 30 seconds before the Fed announcement, so nobody can say anything that we didn't know or anything. Just looking at the Fed Watch tool here, 100% no cut. I've checked a few, maybe a week ago, and there was a chance maybe of a rate hike as well. What do you make of the Fed right now? What should they be doing?
Yeah, of course, this is Powell's last meeting as Fed chairman. My guess is even if we're not the last one, there's virtually no chance of a rate cut given where we're at with inflation. And not that inflation's I'm not worried about inflation as much as the street is, but inflation is ticking up. So the Fed would look at that and say, the economy seems sound, inflation's ticking up. Why would we cut here? We need to give it more time. So I think it's, the odds are obviously right that we're not going to see a cut. I also think, though, given that it is Powell's last one, I think there'd be little likelihood of a hike now. But I don't think there's any likelihood because I don't think he wants to do that on his last meeting. Like I said, I think even if that were not the case, the odds are very high that they wouldn't hike. But that virtually rules it out, in my opinion. He wants to hand this thing off in kind of neutral territory and say we did our jobs.